Albert Einstein's been quoted as saying that compound interest is the eighth wonder of the world. He who understands it earns it, and he who doesn't pays it. Now, in reality, he may have never actually said this, but it doesn't stop it being true. It's one of the most important things that we should all understand, and it's how we can turn a few humble pounds into a fortune. However, as simple as some people make it out to be, compound interest is actually something that a lot of people still get wrong. So in this video, I want to really get to the bottom of it and show you how it works. That way, once you fully understand it, you can be the one who earns it and not one of the people who pays it. So here's the eighth wonder of the world in action. Let's say that we start with £1,000 and we get an interest rate of 10% every single year. Let's just pretend that we get that rate in a savings account at our bank and there's nothing else we need to worry about. All we do is put this £1,000 in and watch the magic at work over the years. After just 1 year, our £1,000 will turn into £1,100. That's 10% worth of interest on £1,000. 10% of £1,000 is £100. Hopefully I haven't lost you just yet, otherwise we really are in trouble. Now, here's where the magic can start to happen if we keep our money in this same account. If we keep getting 10% every year, we start to make more and more money each year. In year 2, instead of just making £100 from our money, we're going to make a little bit more, because now, instead of 10% interest on £1,000, we're going to make 10% interest on £1,100. So £110 will now be how much we make in year 2. This takes our grand total to £1,210, all good so far. Now, if we carry this on for 10 years in this example, we turn our £1,000 into £2,593.74. We end up making more money than we ever put into the account in the first place. But this isn't the most interesting thing. The best thing about how all of this works is that the growth in our account accelerates the longer this goes on for, as we're getting more and more interest, even though the percentage of interest is staying the same. The longer you do it for, the steeper this curve gets here. This is exactly what compound interest is, and it's why it's just so powerful. However, there are a few things that people don't understand or just get wrong, which could be costing them and holding them back from enjoying this lovely steep curve. Let me ask you a question. I'm going to give you 2 options of different investors, and you get to choose which option you want. Now, the first option is investor A. They'll get 6% a year for 40 years for their returns. Nice and steady all the way, really, really simple. Or you can have investor B, who will get 0% for the first 10 years, but then they're going to get 8% for 30 years. If you want the greatest returns, which one are you going to pick? I think the most tempting one to choose is option B, as you would assume that getting 8% for 30 years will surely beat someone getting lower returns even if they do it for a few more years. The reality is that investor A is the one who actually wins. It's not by much and it is a pretty close race, but the slow and steady investor manages to beat the other one even if they don't get the returns as high. So that's the first lesson here. Compounding is really all about the long term. Returns are nice to have, and if you can get them as big as possible, that's great, but it's much better to have many years and decades at a lower rate than just a few at a larger one. This lesson is really important because it's a good reminder about what really matters for long-term investors. I think it's really tempting all the time to keep changing things that you invest in, most latest and exciting things, whether it's AI, crypto, robotics, or microchips. You might see everyone else making better returns in really short amount of time. However, in the long term, it's almost impossible to keep getting these decisions right time after time. If it was easy to get high returns every single year and magically know what stocks or investments are going to do well, then everyone would do it. For me, this is just a good reminder that it's much better to just be consistent over the long term than trying to gamble in the short term. Following on from this, let me just dispel a few myths that are around what compound interest is. These are real questions that I've had over the years left on my videos, and if I get those left as comments, I know that there must be a few more people out there thinking in the same way. The first one goes something like this. I've heard about compound interest in my account, but how long do I have to wait until it kicks in? When do I see it happening? It's an interesting question, and I can see where it's coming from. The answer is that there's no date or time that you'll see compounding work. It's not like there's a single day where you'll suddenly see all of the gains in your account. Compounding is a process that's always happening, but it's also one that can happen the other way as well, and it definitely doesn't have to be consistent in a straight line. You can easily have plenty of times in your investing journey where you see less money than you put in, especially if you have a stock market crash. You can wake up one morning and your account, which was in the green, can suddenly change to being red. Compounding has nothing to do with what the market does at any given time. It's just the process that you hope will happen over the longer term, but there's certainly no specific date or time that you will physically see it in your account. I guess if you want to compare it to anything at all, you could imagine that it could be similar to growing up as a kid in height. If you compare your height from one day to the next, you'll probably see no difference at all. Week to week, it might even be the same, but when you compare your height from a few years back, that's when you'll really start to see it. Secondly, here's another question that I got asked. Someone once asked if compounding works better when all of your money is in a single investing account. They were worried that if they had their stocks and shares ISAs in two different platforms with half of their money in each, that this would mean that they would be losing out. Let's just do the maths and see what happens. Assume we've got £1,000 in one account or two lots of £500 in two different ones. If you were to get a rate of return of 10% in that year, then your £1,000 account will turn into £1,100. Now your £500 accounts will each get £50 as that's 10%. So when you combine your two lots of £50, you still end up getting £100 worth of interest to kick off that compounding. In short, it doesn't matter if you have 10 accounts or one account, compound interest doesn't care. What really matters is having that money invested in the first place and making sure that you're in the position to do it for a very, very long time. Here's another comment I got about compounding that I'm sure other people have got worried about as well. Someone once said that they thought that if they sold all of their current investments and changed them over to a fund with some lower fees, that this could mean that they lose their compounding. Again, just like the example before, the effects of compounding don't care about what platform you use, how many accounts you use, or what kind of index funds you like being invested in. It's a process that's always happening on the way up and the way down. In this example, all you're really losing are all of the past gains data in your account, which I know from first-hand experience is nice to have. If you ever move accounts or change your investments, you don't suddenly lose everything. It's just that your data starts again, but not your compounding. Hopefully that all makes sense. You just have to imagine that compounding is something that is always happening on the way up and on the way down. It doesn't matter if it's 1 week or 1 year, the process is always taking place. It's just that we see the effects of it in the longer term much greater than we see the effects of it in the short term. So we can easily assume that in the short term, nothing much is actually happening. Okay, so as amazing as compound interest is when it's working for you, it can also work against you too. And this is something that has caught people out for decades. Now, in the investing world, there's one thing that everyone should be aware of and really pay attention to, and that thing is fees. Now, fees and charges can have a major impact on how much you end up with inside of your investing account, and they're one of the only things that we can actually control. Ultimately, we have no idea what our returns are going to be or how good the economy is going to hold up over the long term. But fees are known today and we really need to get them under control. Let me show you an example quickly. Now, many of you out there might be aware that some professional investors will charge you to invest your money with them. A popular fee structure that's been around for many decades is called the 2 and 20. It's 2% fee every single year, no matter what happens to your investment, and then a 20% performance fee on profits when things are going well. On the surface, this might seem like a good deal. 2% doesn't really sound like much, and then 20% also seems fair if they're making a killing. The issue, however, is not about what happens in the short term, it's about what compounds in the long term. Now check out this graph here. This shows 3 different outcomes for someone investing $1,000 and letting it invest for 30 years, getting an amazing 15% a year. This top line here shows you that if there were no fees at all, this person could have ended up with more than $66,000. However, we need to come back to the real world for a second and accept that there are always fees when it comes to investing. The next line down is what happens if this investor is charged 2% every single year. Again, it sounds like a really tiny number, but the issue shows itself in the long term. As the fee comes out, it's also reducing the amount of money that can compound. So the longer it goes on, the worse it gets. This investor ends up making $36,000, a whole $30,000 less than they would have done before. So basically, the amount almost halves. The worst part though is the line below here. This shows what happens when a 2% fee is taken as well as a 20% performance fee. For this investor, they end up with just $18,000. Now, the real issue here isn't the amount itself, it's the fact that the fees compound year after year. So rather than getting 15% returns per year, you really end up making 10% a year once everything's been taken off. Or, to put it another way, you make 70% less in money terms if you pay these kinds of fees. At this point, it's no wonder how the professional money managers are the ones driving the Lambos, and you're scratching your head wondering where all of your money went. Unfortunately, even in today's market, you can still find plenty of companies charging you obscene amounts of money to manage your investments. Just remember the old saying that Vanguard founder John Bogle made famous: you get what you don't pay for. Compounding fees can work against you just as much as they can work for you on the way up. So pay attention and make sure you fully understand what you're actually paying your money for. Now, if you want to see what compound interest can do in the real world and see what investing £10 a week for 20 years can do, here's a video I made showing you exactly what happens in the long run. I think you might be surprised just how it all turns out. I'll see you over there, and as always, happy investing.